Based on the multi-asset chart provided for December 31, 2025, here is a technical and macroeconomic analysis of the current market regime, specifically focusing on the recent downside momentum in the S&P 500. 1. S&P 500 analysis, the breakdown. The S&P 500 is currently exhibiting a bearish shift in market structure on the 1-hour timeframe. Break of structure, BOS. The index has decisively breached the critical psychological and technical support level at 6,197.76, the red horizontal line. This level previously acted as a floor, and the failure to hold it suggests a transition from a bullish trend to a corrective or bearish phase. Price action and volume. The sharp, impulsive candles heading towards 6,865.37 indicate aggressive selling pressure, likely triggered by a combination of institutional profit-taking at year-end and the execution of stop-loss orders resting below the 6,900 handle. Technical outlook. The price is currently in price discovery to the downside. Traders will be looking for a potential retest of the broken support, 6,897, to see if it flips into resistance before further decline. 2. Intermarket correlations and drivers. The weakness in equities is not occurring in a vacuum. It is being driven by specific movements in the bond and currency markets seen in your other panes. U.S. 10-year Treasury yield, U.S. 10Y. The yield spike. Note the orange line in the second pane. Even though the daily change shows 0.19%, the recent intraday trajectory is a sharp rebound toward 4.163%. Equity impact. Rising yields increase the discount rate used in valuation models, making equities, especially high-growth tech stocks, appear more expensive. This higher-for-longer narrative regarding Fed rates is the primary headwind for the SP 500. U.S. Dollar Index, DXY. Safe haven bid. The DXY is holding firm at 98.265. In a risk-off environment, capital flows out of risk assets and into the USD. A resilient dollar exerts downward pressure on dollar-denominated assets. Gold, XAUUSD. Post-crash consolidation. Gold is trading at 4,321.59. The chart shows a massive impulsive drop from the 4,500 region recently, likely due to the CME margin requirement hikes and the rising US 10Y. It is currently in a distribution or consolidation phase, lacking the momentum to decouple from the bearish pressure exerted by the strong USD and yields. AUD-JPY, the risk barometer. Sentiment confirmation. AUD-JPY is currently trending downward at 104.562. As a classic proxy for global risk appetite, a falling AUD-JPY confirms that the carry trade is unwinding and investors are seeking the safety of the Japanese yen. This perfectly correlates with the sell-off in the S&P 500. Hit like and subscribe to stay ahead of the curve with our daily technical insights and trade recommendations for the S&P 500.